In this video series, we're going to talk about what is PMI and why do some loans require PMI. So I'm going to do a quick screen share and use an example loan that I have up that is a government loan. In this particular loan, it's what's known as an FHA mortgage. So FHA is the Federal Housing Authority. These loans actually carry two types of PMI. There's an upfront, which is this fee here that's financed into the loan. And then there's also a monthly PMI. Now, what makes the government loans unique is that most of them, FHA, USDA, will have a monthly PMI that lasts for the lifetime of the loan. With FHA, if you put a larger down payment, 10% or more, the PMI will fall off after 11 years. If you're a veteran, it's kind of a misnomer, but it's still an upfront mortgage insurance premium. It's an upfront funding fee. For a veteran, they do have an upfront fee, but the veteran will not have a monthly PMI. If the veteran is a disabled veteran, they'll actually have no upfront fee at all. A conventional mortgage, so if you've ever heard the terms Fannie Mae, Freddie Mac, it is not a lifetime PMI. The PMI has actually three ways in which it could fall off. One is when you hit 78% of the value, it automatically falls off. And that's 78% of your original value. So let's use low numbers, especially low numbers in this real estate market. A low number would be you bought a house for $100,000 and you're financing $90,000. When you hit $78,000, it's an automatic drop off, provided that you've made your mortgage payments on time. Now, let's say that same 100,000 house, you notice that houses like yours are selling for 120, 130, 140. You can reach out to customer service and see like, hey, can I get rid of my PMI? And they may say to you, yes, we can look it up online and we can see that you have enough value. Or you may have to pay for another appraisal to evidence that you have enough equity in your home. Equity is the difference from your value versus what you owe. The other way is that you refinance, and you refinance if it makes sense and if it makes sense to remove it. So what is PMI? PMI protects the lenders. So let's say, for instance, you owe $200,000 on your mortgage and something happens and you lose the house to foreclosure. House sells at auction for $150,000. The bank is made whole. That $50,000 deficit is paid by the PMI company. So it doesn't give a benefit to the consumer, it gives a benefit to the lender. All loans where you're not putting down 20% on all conventional mortgages, they will have PMI. If you hear a lender say to you, hey, no PMI loan with 5% down, no, you're just either having a higher interest rate or you're paying the fee up front. Loans that have less than 20% down on conventional require PMI. So there is no magic there. On the downside, let's say that you have to go with an FHA mortgage for whatever reason. Maybe it's a credit thing. Maybe you had a short sale 3 years ago and you can't get a conventional mortgage and you're putting 25% down. You still will have that PMI for 11 years. So I hope this helps you understand a little bit about PMI. Any questions at all, reach out and subscribe to my YouTube channel. Thanks.